The Great Currency Reset: How Gold and Silver Will Explode. Have you ever considered that the stock market, the very symbol of American prosperity, might be worth less today than it was nearly a century ago? It's a startling proposition, one that challenges the core narrative of perpetual growth we've been sold for generations. When priced not in ever-depreciating dollars, but in the timeless measure of gold, the Dow Jones Industrial Average is actually down by a third from its peak in 1929. This isn't just a statistical anomaly. It's a profound revelation about the illusion of wealth created by relentless currency debasement, and a signal that the foundational assumptions of modern investing are beginning to fracture. We stand at the precipice of a monumental shift, a crisis of confidence in the very bedrock of the global financial system, the United States dollar. For decades, the world has operated under a framework where the dollar was the undisputed king, and US government bonds were the safest asset a nation or individual could hold. This system, known as dollar hegemony, has afforded the United States an exorbitant privilege, allowing it to run massive deficits and fund its spending by simply printing more currency that the rest of the world was obligated to accept. That era is now drawing to a violent and disorderly close. The problem is not a temporary downturn or a cyclical market correction. It is a deep, structural failure rooted in decades of reckless fiscal and monetary policy. The U.S. national debt has spiraled to unimaginable levels, with no politically viable path to fiscal responsibility. Regardless of who occupies the White House, the deficits continue to grow, promising only one outcome: the monetization of that debt through massive inflation. The world's central banks, the primary enablers of this system, are finally recognizing that they are holding claims on a currency that is programmed to lose its value, and they are beginning to act accordingly. This systemic decay has been accelerated by a series of catalysts that have shattered the illusion of stability. The aggressive use of financial sanctions, particularly against Russia, served as a global wake-up call. Nations across the planet realized that their dollar reserves could be frozen or seized at the whim of an American president, transforming a financial instrument into a political weapon. This act of strategic overreach has irrevocably damaged trust and has sent a clear message to other countries: holding dollars as your primary reserve is an existential risk. It forced a global reassessment of counterparty risk, with the U.S. government now seen as an unreliable custodian of wealth. The tipping point is no longer a distant threat on the horizon. We are living through it right now. The most telling evidence comes from the very heart of the establishment. For the first time in modern history, a major Wall Street firm, Morgan Stanley, has officially advised its clients to fundamentally alter the bedrock of conservative portfolio management. They have publicly recommended slashing bond holdings in the traditional 60-40 portfolio, 60% stocks, 40% bonds, and reallocating that capital directly into gold. This is not a subtle tweak. It is a revolutionary admission of a catastrophic failure in confidence in government debt and the currency in which it is denominated. The implications of this move by a pillar of the financial community cannot be overstated. For 40 years, the 60-40 portfolio was the gospel of wealth management, a strategy built on the premise that government bonds offered a safe and reliable hedge against stock market volatility. Morgan Stanley's new guidance, advocating for a 60% stock, 20% bond, and 20% gold allocation, is effectively a sell signal on the full faith and credit of the U.S. government. It is a public declaration that they foresee a massive inflation risk that bonds are no longer equipped to handle, and that gold is the only viable sanctuary. This institutional capitulation is the crack in the dam that precedes the flood. For years, advocates for gold were treated as lone wolves, outliers in an industry dominated by a belief in the perpetual strength of the dollar and the wisdom of the Federal Reserve. Now the wirehouses themselves are echoing the warning. This is just the beginning. Soon other major firms will be forced to follow suit, creating a self-reinforcing cycle. As institutional demand for gold surges, the narrative will shift, and financial advisors across the country will begin pitching gold and gold-related equities to their retail clients, something that was unthinkable just a few years ago. Simultaneously, We are witnessing an unprecedented and accelerating campaign of de-dollarization by the world's central banks. These powerful institutions are systematically divesting from US dollars and treasuries and hoarding physical gold at a historic pace. This isn't a speculative bet, it's a strategic retreat from a collapsing system. They understand that the only way the United States can possibly meet its debt obligations is by creating massive inflation, thereby debasing the very assets they hold. They are choosing to exit the burning theater before the stampede begins, trading digital promises for the immutable, time-tested security of physical gold held in their own vaults. This global exodus from the dollar creates a terrifying feedback loop for the American economy. The United States is utterly dependent on foreign nations wanting to hold dollars and reinvest them in US government debt. This inflow of capital is what has allowed Americans to live far beyond their means, consuming more than they produce. As the world sells those dollars and treasuries, the demand for US debt will evaporate. To attract the remaining buyers, interest rates will have to rise dramatically, regardless of what the Federal Reserve wants. This is the mechanism through which the American standard of living will be forced to violently contract. The immediate impact on American households will be brutal and unforgiving, manifesting as a two-pronged assault on their financial well-being. First, the value of the dollar will plummet on foreign exchange markets. While the average person may not track the dollar-yen exchange rate, they will feel its effects every time they go to the store. The cost of imported goods will skyrocket, compounding the inflationary pressures already present in the economy. Everything from electronics to clothing to food will become substantially more expensive, eroding the purchasing power of every dollar earned and saved. Second, interest rates will surge across the board, impacting every facet of American life. The cost of borrowing for homes, cars, and credit card debt will become prohibitively expensive for millions. A government that desperately needs low rates to service its own colossal debt will find itself in a fiscal death spiral, as rising interest payments consume an ever larger portion of the federal budget, necessitating even more money printing. This cycle of rising prices and rising interest rates is the classic definition of stagflation, a toxic economic environment that decimates both businesses and households. Amidst this turmoil, many have sought refuge in what they believed was a modern alternative to gold, Bitcoin. Marketed as digital gold, it was supposed to be the ultimate inflation hedge, a decentralized asset free from government control. However, in the face of a genuine crisis of confidence, its performance has been deeply underwhelming. While gold has been making new highs, Bitcoin has been in a bear market when measured against real gold. It has lost significant value relative to the yellow metal over the last few years, even despite the massive hype generated by the launch of Bitcoin ETFs and corporate treasury purchases. This underperformance exposes a fundamental vulnerability. Bitcoin's value is derived almost entirely from speculation and collective belief, a digital Ponzi scheme, as some critics would argue. It possesses no underlying intrinsic value. Gold, on the other hand, is a tangible asset with thousands of years of history as a store of value and a medium of exchange. Bitcoin's failure to outperform gold during a period of rising inflation fears and geopolitical uncertainty suggests that when a true crisis hits, speculative assets will be discarded in favor of tangible ones. The Johnny-come-lately investors who bought into the ETF hype will be the first to sell, potentially triggering a catastrophic price collapse. Ironically, the technology that underpins cryptocurrencies may yet find a legitimate and powerful use case, not in creating value out of thin air, but in mobilizing the value of real assets. The tokenization of physical gold represents a significant potential innovation. By creating a digital token that represents direct ownership of physical gold held securely in a vault, it becomes possible to transact with the speed and efficiency of a cryptocurrency, but with the backing of a real, tangible asset. This would allow individuals and institutions to transfer ownership of gold instantly and cheaply, without the logistical challenges of shipping physical metal. This tokenized gold could function as a true medium of exchange and a unit of account, offering a stable and reliable alternative to both volatile cryptocurrencies and depreciating fiat currencies. It would combine the best of both worlds, the timeless security and value of gold with the transactional efficiency of modern digital technology. This stands in stark contrast to nearly every other crypto use case, which often amounts to little more than speculative gambling. It's a practical solution that could play a crucial role in the transition to a new monetary system, one grounded in real value rather than government promises. While institutional and central bank demand has been the primary driver of gold's recent rally, the retail investor has been conspicuously absent. Distracted by the allure of tech stocks and cryptocurrencies, the average person has not yet reacted to the record-breaking rise in precious metals prices. This is a typical pattern. Retail investors are usually the last to join a major market trend. However, at some point, a trigger, perhaps gold crossing a major psychological barrier like $5,000 an ounce, or silver surging past its old highs, will capture their attention and the fear of missing out will set in. When the retail component finally awakens, the move in precious metals could become truly explosive, particularly in the silver market. Silver is often called the poor man's gold, and its market is significantly smaller and more volatile than gold's. While central banks are unlikely to buy silver due to its bulk, it is the preferred asset for smaller retail investors. A surge in retail demand, layered on top of silver's critical and growing industrial applications, could create a violent supply-demand squeeze. The potential upside for silver is therefore an order of magnitude greater than that of gold. Looking forward, a silver price of $100 or even $200 per ounce within the next 3 to 5 years is not an outlandish forecast. It is a logical consequence of the unfolding monetary crisis. With silver currently trading at less than $50 an ounce, it represents a deeply undervalued asset with multi-bagger potential. A decisive break above its long-standing double top near $50 would likely ignite a parabolic move, as both monetary and industrial demand converge on a market with very little available physical supply. This could be one of the most compelling investment opportunities of the coming decade. The political landscape offers no hope for a reversal of these trends. The inflation we are experiencing is the direct consequence of bipartisan fiscal profligacy. The worst year of inflation under the Biden administration was largely a hangover from the unprecedented money printing that occurred during the final year of the Trump administration in response to the COVID pandemic. While inflation has since backed off its highs, it is now poised to reaccelerate with a vengeance, fueled by the policies of the current Trump administration and a Federal Reserve that has lost all credibility and independence. A second Trump term is likely to be even more inflationary than the first. The passage of fiscally irresponsible legislation like the Big Beautiful Bill signals that there is no appetite in Washington for cutting spending, regardless of campaign promises. Furthermore, direct pressure on the Federal Reserve to slash interest rates and ignore inflation, coupled with attempts to stack the board with political cronies, destroys any remaining pretense of central bank independence. This political capture of monetary policy is a flashing red light to the rest of the world that the dollar's debasement is now official, explicit policy. As a result, the lowest year for inflation during this presidential term is likely to be the first one. From here, the trajectory is upwards, creating a far more problematic and persistent crisis than the last inflationary wave. When prices are continuously getting worse month after month, deep into a presidency, it erodes public confidence and creates immense social and political instability. This environment will be devastating for savers, retirees, and anyone on a fixed income, as the value of their money is systematically destroyed by their own government. The mainstream view of the stock market as a source of wealth creation is a dangerous illusion in this environment. While nominal stock prices may continue to rise, fueled by relentless money printing and a return to quantitative easing, their real value, measured in gold, will continue to plummet. The Dow Jones reached an all-time high of 40 ounces of gold in the year 2000. Today, it stands at just 12 ounces, a staggering 70% drop in real terms over 25 years. This reveals a massive hidden bear market that has been masked by currency inflation. This perspective is critical for understanding true wealth preservation. A Dow at 50,000 means nothing if gold is at $5,000, and it means even less when you consider that gold was just $20 an ounce in 1929. The government and the financial media want the public to focus on the high nominal numbers because it creates a sense of prosperity. However, the only way to accurately measure the performance of assets over time is to remove the distorting effects of inflation by pricing them in a constant measure of value, which historically has been gold. By this measure, American stocks have delivered a negative return for nearly a century. The coming economic storm will not be confined to precious metals. We are on the cusp of a major secular bull market in all commodities and hard assets. An inflationary environment, by its very nature, benefits tangible things over paper promises. As the value of currency declines, the price of everything real must rise to compensate. This includes not just precious metals like gold, silver, and platinum, but the entire complex of resources that form the foundation of the global economy. Investors should prepare for a broad-based revaluation of real assets. The energy sector, including oil, natural gas, and even more speculative plays like uranium, is poised for significant gains. Years of underinvestment in new production, combined with geopolitical instability and rising global demand, are creating the conditions for a sustained period of higher energy prices. This will act as a further tax on consumers and businesses, exacerbating the stagflationary pressures that are already building within the system. Owning the producers of these essential resources offers a direct hedge against this trend. Industrial metals such as copper, nickel, and zinc are also positioned for a major repricing. These commodities are essential for global manufacturing, infrastructure development, and the so-called green energy transition. Decades of prioritizing financial engineering over real-world investment have left supplies constrained, while demand remains robust. As the world loses faith in paper assets, capital will flow into the tangible assets that are indispensable for economic activity, driving prices significantly higher and rewarding those who invested in the producers of these vital materials. Even agricultural commodities will participate in this overarching trend. The cost of producing food is directly tied to energy prices and the overall cost of living. In a highly inflationary environment, the price of food can rise dramatically, leading to social and political unrest. Farmland and agricultural producers represent another form of real, tangible wealth that provides a necessary defense against the ravages of currency debasement. The coming era will favor those who own the means of producing real things over those who hold claims on depreciating paper. The collapse of a currency's reserve status is not a theoretical event. It is a painful and chaotic process that dismantles the lives of ordinary citizens. For Americans, the end of dollar hegemony will mean an immediate and severe decline in their standard of living. The ability to import cheap goods from around the world will vanish. The nation will be forced to live within its means, which will come as a profound shock to a society built on credit and consumption. Shortages of certain goods will become more common, and the quality of life that previous generations took for granted will become a distant memory. The ultimate aftermath of this crisis will be a fundamental reorganization of the global monetary order. The unipolar, dollar-centric world is over. In its place, a multipolar system is likely to emerge, one where gold is re-established as a neutral reserve asset at the center of the system. This does not necessarily mean a return to a classical gold standard overnight, but it does mean that the value of currencies will be increasingly measured against gold, and nations that hold significant gold reserves will have a more powerful seat at the table in shaping the new financial architecture. The primary lesson from this unfolding crisis is timeless. Governments cannot be trusted to maintain the value of fiat currency. Without the discipline of a hard asset backing, the political temptation to print money to fund spending and promises is irresistible, leading always to the same destination of currency collapse. The current situation is not a unique failure, but the predictable endgame of a 50-year global experiment with unbacked paper money. The great wealth transfer is now underway, moving from those who hold paper assets to those who own real, tangible things. The time to choose which side of that transfer you are on is rapidly running out.